Corporate Finance Presentation. Weighted Average Cost of Capital, or WACC, W-A-C-C. Get ready, it's time to take your chance with Corporate Finance. Weighted Average Cost of Capital, WACC, W-A-C-C. As we go through this formula, remember we're thinking about financing options, major two financing options of the operations of the organization, of the company, being debt financing, equity financing. So we'll go through this formula in total, and then we'll think about in future presentations and with practice problems how to calculate certain components of this formula that you can then put into perspective within the formula. So remember, as we think about our financing options, we want to get an idea of our capital structure. This is one way to do so. So we got the WACC equals E over D plus E times RE plus D over E plus E times RD times 1 minus T, where E is the market value of equity, D is the market value of debt, RE is the cost of equity, and RD is the cost of debt, and then the tax is going to be the tax amount for T. Now this looks very intimidating and confusing. We'll break down these two components here, D over D plus E and D over D plus E, shortly. And then these two items, R of E and R of D, are basically the cost of debt and the cost of equity. And you can think about the cost of debt is probably the more straightforward one for people to think about if you're issuing something like bonds, which we'll talk about in the future. Then you have a situation where you're going to be paying, of course, the interest on the bonds. We issue bonds in order to generate revenue, in order to get funds for the financing. We're going to have to pay for it with interest. That's going to be the rent on it. And there's going to be a tax impact, which is going to be something that we're going to be thinking about for the debt. That's one of the things that makes it confusing when we consider debt financing and equity financing, because we have that tax impact. On the equity side of things, we're typically thinking the common type of thing to issue being common stock, which means we're giving ownership in essence to the company, giving in essence value of the retained earnings, assets minus liabilities, the equity value of the company. That one also confusing to calculate here, more confusing than basically the interest in concept, because we have to basically make assumptions about the future. What's the value of the company? What's going to be the growth of the company? So these two concepts, we will then go into future presentations and think about how to calculate them more as we go. These two, the division items here, E over D plus E and D over D plus E, we're going to think about conceptually here, and we won't do a lot of problems on this component or in this section because we're going to be focusing in on our practice problems to calculate these two items. So let's break this down a little bit further. Let's first start with our accounting equation. So our accounting equation is assets equal liabilities plus equity. Assets are what the company has, liabilities and equity are who has claim, in essence, to those assets. So whatever the company has, then third parties' liability have claims to them outside of the organization. Equity represents the owner, and if we're talking about a corporation, we're talking about stockholders' equity. So these two, liabilities and equity, we could think of as financing the assets. The assets will then be used in order to generate the revenue. Now you can kind of think about this on a book basis or a market basis, and that gets a little bit kind of confusing because the accounting versus the fair market versus the market value and whatnot. But just conceptually, we have here the accounting equation: assets equal liabilities plus equity, liabilities and equity being the financing options. If we rewrite the accounting equation, we could see assets equal, and we're just going to say debt now. Instead of liabilities, we're just going to call it debt plus equity. Assets equal debt plus equity, because that's the terminology we're going to be using in our formulas from a financing perspective. And then we can use our algebra here to solve for equity, which would give us equity equals assets minus debt. So equity would then equal the assets minus the debt. And that's a useful way to see the formula, because that shows us that the equity, which in this case stockholders' equity, we're talking about a corporation, is basically the value of the organization. I mean, assets of the organization, what they have, minus the debt, the liabilities, what's owed to third parties, is the value of the organization. So when you think about equity financing, issuing common stocks in essence for a corporation, you're kind of thinking about this as a useful way to think about the accounting equation. So then we can look at the debt percent. If we look at the debt percent, that would be the debt over the assets. So we have our calculation here. We can think of the debt over the assets and the equity over the assets. And the sum of those two should be at 100%. This is going to be our weighting that we will have. So debt over the assets. Notice that the assets down here, we showed that assets are equal to debt plus equity. So assets are equal to debt plus equity. So I can rewrite this as debt over debt plus equity. Debt over assets is equivalent to saying debt over debt plus equity, because debt plus equity is equivalent to the assets. And then over here, we can say the equity percent. If we think about the equity percent, it would be equity over assets, simply rewriting our equation here, or thinking about our equation in terms of debt over assets and then equity over assets. The two of those then have to equal then 100%. And we have equity over assets is the equivalent to saying equity over debt plus equity, because once again, debt plus equity is assets. Assets equal debt plus equity. So these are the two kind of components, the ratio components of our formula. We won't spend a lot of time on calculating those in our practice problems, but you can get an idea for it conceptually here. So if we go back to our formula, that in essence is going to be this item and this item. So we won't spend, again, a lot of time on those two. We're going to be spending our time on RE and RD, the cost of debt and the cost of equity. So that's going to be our calculation. So we looked at these two basically conceptually, our weighting between the debt and equity, and then we consider basically our cost of debt and cost of equity with relation to it. And then these two, the cost of debt and equity, are going to be somewhat complicated to calculate, and that's what we'll focus in on our time, remembering that the cost of debt will have taken into consideration the tax impact. Now you can write this down in basically like a table format down below, so you can basically put this formula into like a table down here for something like this. It would look something like this. We will work a practice problem with this, so I highly recommend working through the practice problems. We have the debt. So if the cost of debt, and this debt is after taxes, so it's already taken into consideration, the tax impact up top is 6%. So that would mean that if we think about that cost of debt, we're saying this is the financing cost for us. Financing cost for debt typically being interest. But when we think about interest and we want to weight it against other financing costs, such as equity financing, we want to take into the account the cost of the taxes, or the impact of the taxes, which are actually a tax benefit. So when we think about the interest rate, we'll have to adjust it. When we think about bonds, which is one of the most confusing ones to do in this category, we would say, okay, the interest rate is what? Is it the rate on the bond, or is it the market rate? Typically, we'll use the market rate. We'll get into more detail on that, why we would do that. And then we have to think, well, now there's a tax impact for it as well. What's going to be the tax impact, so we can see what the real cost is after taking into consideration those items. Then we're multiplying it times the weights, which is going to be our weighting between the debt and equity, to put it in perspective with regards to our capital structure. And then we're going to get then the 2.4 for our weighted cost. Then the common equity or retained earnings, we're going to say the cost after tax. There is no tax impact here, so after tax would be the same amount, because it would be equity financing is 12%. Not as straightforward to think about conceptually, because we're not paying in the format of interest when we issue equity. What we're getting instead is we're giving basically equity interest in the equity and the earnings of the company, and basically the retained earnings and the equity of the company, and thinking about how that might grow in the future. So this becomes a little bit complex. This is an estimate for us to make. Once we get that number, then we can multiply that times the weight to put it into perspective, the weight between the equity, the debt and equity, and our financing options, and that will give us then our 7.2%. If we add this up, the 2.4 and the 7.2 is the 9.6. This would then be an attempt for us to get basically our required rate of return, our floor rate, in order for us to be approving of a particular project. So whether we be using the debt financing at the 6% or the common equity financing, the equity finance at the 12%, under this calculation, we want the floor to be our required rate of return to be the 9.6. And that allows us to basically look at different opportunities that we might have without being distorted with regards to the weighting of what types of financing options should be there. And it gives us a quick look to be able to compare different types of things that we could be investing in. So that's one kind of concept, one component that we can basically use for our basically our investment decisions and cost of capital type of decisions. Now, also note that this formula up top doesn't include the preferred stock, so you could tack on preferred stock if the company has preferred stock, which would complicate things a little bit. I didn't adjust the formula. We'll just look at the table, what the table might look like if you add the preferred stock. Be something like this. You got the debt at the 6%, the weight is going to be 40%. Notice that these weights add up to 100% because that's, these weights should add up to 100%. So the 6% times the 40% is the 2.4%. Preferred stock now, we're saying the cost after tax is the 10%. The weight we're going to say is 10%. So 10 times 10 is going to be the 1%. And then the common equity is going to be the 12% times the weight of 50% or 6%. Adding those three up, that's going to give us the 9.4. So we will go into the preferred stock as well and think about this calculation. So this is where our major focus will be going forward as we go forward and work through practice problems, calculating the debt and the cost of debt, the cost of equity, cost of preferred stock, equity type of financing. You want to keep in mind how you might want to measure that or think about that against other financing options and how you might put it into a WACC type of calculation as well.